Ladies and gentlemen, I asked during this market turmoil, as investors, what sectors do you find most attractive? And oh boy, did you answer with more than 70 votes over oil and energy, leisure and gaming, even airline and auto. Ladies and gentlemen, you chose real estate investment trust. So today we're going to take a look at some of the largest REITs in the US and Canada, and then we're going to take a look at my two favorite REITs, Realty Income along with Riocan, and how are they surviving and are they still paying their dividends? So ladies, gentlemen, I look so forward to breaking this down for you. Let's just hop right into this.
Drop it.
Welcome back, my passive income investors. I like to kick all of this off. We're going to start on the U.S. side of the border with currently the two largest market capped real estate investment trusts. We're talking American Tower Corp along with Crown Castle. And I was shocked when I was looking at these charts because considering the scale that these things set out, I couldn't figure out how they were performing so well until I said, oh, I had a light bulb moment. These are telecommunication REITs.
Towers across every city, town, and community
keep us connected to what matters most.
Instantly delivering voice, text, and data to the devices we depend on.
Small cells, hiding in plain sight, improve coverage and set the stage for new advancements, like the Internet of Things,
Smart city technologies,
and 5G.
eventually delivering up to 20 times the speed of current networks.
They primarily just rent space, I guess, to build telecommunication towers and take some payments from those phone companies. But either way, these conglomerates trade at massive percentages right now, with the market cap on American Tower being at $112 billion with a PE of 59. But I think there's discrepancies in those PEs on Google. And with a dividend yield of 1.17%, doesn't seem that attractive. But we're going to take a look at the dividend in a sec, with Crown Castle trading at $67 billion, a 91 PE, which I still don't think is accurate, and a 2.95% dividend yield. Mind you, these don't get paid monthly, and the more you look into it, with these things being at all-time highs, these low dividends, you might not think they're attractive until you start looking at their past history. And oh my goodness, guys, taking a look at American Tower dividend going all the way back to 2012, it has gone from 20 cents all the way up to 92 cents. That means it has doubled more than 4 times in less than a decade. So that 1% really starts itching up fast. And I mean, taking a look at something like the Crown Company here, guys, which only goes back, I think, on this page to 2014, from 35 cents all the way up to $1.20. The same kind of crazy performance growth in those dividends, but I find that's how most US REITs operate. They usually start off by paying a lower yield, reinvest that into building up new properties, getting some new real estate investments, leading into this incredible growth if you could just hold on to it long enough. But let's compare it to the Canadian side of the border. I found the two top Canadian REITs. We're talking about Canadian Apartment Properties and Allied Properties Real Estate Investment Trust, guys. They always sound the same for some reason. But let's start with Canadian Apartments being the largest one with only a $7.8 billion market cap, which, I mean, is nothing colossal in comparison, guys. With a PE of 6, though, and a dividend yield of 2.99, these companies don't look nearly as appealing, in my opinion. But you got to keep in mind population density, ladies and gentlemen. There's like 500 million people in the US and just under 40 million here in Canada, which really reflects in these market caps, considering in Canada, you're not really going to find those like telecommunication REITs. There are some like industrials that are much smaller, but on the larger scale, it's all based around malls, townhomes, student housing, condos. I mean, that has been the primary growth factor behind these Canadian REITs. And I know after doing some research, Canadian Apartment Properties even has extended their portfolio, I think, into the Netherlands. And I'm not sure how that happened, but it's nice to get a little global diversification. But I mean, Canadian Apartment REITs has had the best performance by far. And taking a look at Allied Properties, it has taken a much bigger dip with a 3.97% dividend yield, a 7 PE, and a $5 billion market cap. I mean, it's not bad, but if you put them in a basket, side-by-side kind of comparison between those US conglomerates and these Canadian conglomerates, 9 times out of 10, guys, the US ones are always going to win. Even though those dividends are lower, they just grow way faster. The only difference I find with Canadian stocks is you get a monthly yield usually on a REIT, and on top of that, the monthly yield is usually much much higher, even though it doesn't grow as fast. And if you're looking for like a quick inject of capital to spend, that is why most people would gear toward the Canadian side of the border for REITs, because you could throw your money at these Canadian giants and immediately start getting a paycheck almost right away. But there's two REITs I primarily want to focus my attention on that I'm sure you want to figure out if they're going to keep paying you those juicy dividends, because I know they're popular amongst the dividend investing community here on YouTube. Of course, I'm talking about Realty Income, and one that I haven't stopped investing in, which is Riocan, ladies and gentlemen. Now, Riocan, keep in mind, is also one of the largest Canadian REITs, and Realty Income is also one of the largest US REITs. But they're both very attractive because they're both taking major hits. They're both paying out really fat dividend yields right now. And I'm sure you're thinking to yourself, how reliable are these? So I want to update you on some of the news surrounding this current pandemic with these specific companies. Now, luckily, Riocan, I think, has got a bad image because it is well diversified away from things like malls. I think they make up about 10% of their portfolio, as most of their new industrial builds going on are primarily focused on condos and rental units and office buildings downtown in Toronto. But the updated news they've provided to investors is in this article they posted just a day ago. And I've scrolled down to find the more important segment I want to highlight on, which says Riocan's permitted portfolio is well positioned to manage through the COVID pandemic. As of December 31st, 2019, 90.1% of Riocan's annualized rental revenue was generated from Canada's 6 major markets and 52.4% from the Greater Toronto Area. With enclosed malls representing only 10% of its portfolio, more than 90% of Riocan's portfolio is comprised of grocery encore centers, mixed-use urban centers. Grocery encore centers alone account for 40.9% of annualized rental revenue as year-end 2019. It's well diversified with a strong focus on necessity-based and service-oriented tenants, and no single tenants account for more than 5% of Riocan's annualized total revenue. Continuing on, in an effort to slow the spread of the CV virus, a number of businesses have closed off on their own volition or to comply with the government's mandated closures. To support small business and independent tenants, as well as small nation tenants, Riocan has offered a 60-day gross rent deferred to such tenants on a case-by-case basis. As of April 20th, 2020, Riocan has approved approximately $15 million of April rents deferrals based on request, representing about 17% of its total April gross rents. Such approved rent deferrals are payable either within the 12 months subsequent to 60-day deferral period. To summarize that really quickly, guys, it is incredible news to hear that tiny percentage. I mean, 17% is a big chunk, but in retrospect to the economic situation we're in, that's actually pretty good. And continuing forward, while the CV pandemic presents unpredictable challenges and its impact is difficult to quantify, the trust expects to collect most, if not all, of its rents over the time given. For the trust's residential operations at East Central in Toronto and Frontier in Ottawa, Riocan has approximately received 96% of the April residential rents as of April 2020. And if I continue to scroll down here, guys, just to summarize up the rest of this so I don't take up too much time, they're also pulling back on some major projects that haven't really started development yet, I guess, to stockpile cash. So they also have $400 million that they're setting aside for further issues they may foresee. And then on top of that, they also have a huge amount of revolving debt that they have capable to them, which I think is up to $1 billion, including some of the cash they have lying around as it stands in this very moment. So I think it's incredible to see a company like this and how it's scurrying around right now, because these managers are having one heck of a hard time dealing with this, as I'm sure many people in their own individual rights are. But I think this company is poised to do exceptionally well, considering I think they only have to survive the next few months. Most of their tenants are already paying because they're grocery stores, Walmarts, Costco's of the world, guys. You don't have to be over concerned about the future of this company. The only thing I don't like is, as I've said in the past, sooner or later chickens come to roost. And if they're taking on debt today, if they're putting money aside to not build new construction projects, at some point in the future, it's either going to have to get paid back. Those new constructions aren't going to come into fruition as fast as they hope, which means I'm not going to get some extra rental income as fast as I wanted. So, I mean, that's kind of the give and take of this. But I mean, so long as they can continue paying that monthly dividend, which they have declared to continue paying, I'm not overly concerned about it, because that's why you own these Canadian companies, guys, is to get that check, that really reliable monthly check. Now, taking a look at Realty Income, which I'm sure many of you are a large fan of, I only have to scroll through their homepage for you guys to get an idea of some of their tenants and how reliable that this company probably fits in with Riocan as well. Primarily renting to things like Walmart, grocers, all that fun stuff, guys. So what is this company doing to help you and survive this current economic situation? Well, they started liquidating some more shares. We got Realty Income closes 9 million shares of common stock offering. And if we scroll down and take a read, the company intends to use its net proceeds from the offering to repay borrowing outstanding under its $3 billion unsecured revolving credit facility. The underwriters for this offering are BofA Securities, Morgan Stanley, Wells Fargo, RBC Capital Markets. I think this was a pretty intelligent thing to do. I think it might be diluting some shares, so your pie might be getting a little smaller, but if they do intend on using this to pick up cheap properties that might come on the market sometime soon, I think it's an incredibly intelligent move. And then on top of that, just like Riocan, guys, they draw $1.2 billion on revolving credit facilities and withdraws 2020 guidance. So, I mean, they're going to be running into the same exact issues Riocan are here, guys. They're going to be pulling back their guidance. They're going to be trying to build up and make sure they have a decent chunk of cash. These companies were already extremely well capitalized for a situation like this, presuming things don't extend to get worse, because it all comes down to the time frame, whether we're going to be out of this in the next few months or whether we're going to be out of this in the next 6 to 12 months. Now, I know I must sound like a broken record, ladies and gentlemen, but I'm just going to touch base on whether I plan on actually using my line of credit to buy into some of these REITs. REITs are the only thing I've ever considered using debt to buy into because the dividend yields are pretty sustainable. They're very high, and with an interest rate of only 5%, I mean, it's going to be pretty easy to pay that back. But I'm working on some strategies right now that I think would make a little bit more sense around me utilizing this, because I just don't want to randomly throw thousands of dollars of the bank's money into this kind of volatile market. But what I might plan on doing is I have a lot of extra capital coming in right now. I've been very fortunate this month, so there's no way for this month I'm going to be able to take advantage of the emergency government benefit. But if that money keeps coming in, I plan on making 3,000 or 4,000 over the next couple of weeks here, guys. What I would like to do is maybe stack that cash up into my emergency fund, keep building my bank accounts. And as that money comes in, what I would like to do is put it into a high interest savings account that'll get me 1.5% or 2%. And then never touching that money and just leaving it there, I can start leveraging the bank's money within reason to my savings. So heaven forbid something horrible happens, I can immediately pay that debt back. But for as long as those dividends keep coming in, I can cash in those dividends off those REITs, use it to pay back the interest. I also get extra tax write-offs because of that. And then if the market decides to come back over the next 6, 12, maybe even 2 years, guys, I could see Riocan doing a 30, 40, 50% upside to it, at which I could liquidate that debt, pay it all back, and then I could pocket 30 or 40% and be getting a really healthy, insanely high dividend yield going forward. So I'm going to sit down, analyze through my options and my plans, and I will let you know if I ever pull that plug. And I'm really just watching the markets closely, but I'm getting really eyeballing on this as Riocan dips back down into the 15s and hopefully goes back into the 14s. But I hope you guys enjoyed this. Slap a like, consider subscribing, stay cool, stay awesome, and I'll catch you tomorrow.